Let's say you're scrolling through social media, and you see a headline that completely contradicts itself. One post says, Bitcoin just hit a new all-time high, and a 22-years-old kid became a millionaire overnight by trading digital coins from his bedroom. You scroll down, and the very next post says, a massive cryptocurrency exchange just collapsed. Billions of dollars vanished into thin air, and regular investors lost their entire life savings. And now you're sitting there completely confused, thinking, okay, what am I actually supposed to believe? To some people, cryptocurrency is the future of global finance, a revolutionary technology that will destroy corrupt banks. To others, it's nothing more than a digital casino, a giant speculative bubble driven by internet hype and internet scams. But here's the problem. Most beginners who try to learn about crypto get completely overwhelmed by the technical jargon. They start reading about blockchains, smart contracts, and decentralized protocols, and within 5 minutes, their eyes glaze over and they give up. Or worse, they ignore the technology entirely, blindly buy a random coin because an influencer told them to, and end up losing everything. So in this video, we're going to do something different. We are going to strip away the complex math, the hype, and the emotional arguments. We're going to explain exactly what cryptocurrency is, how it actually works using a simple, real-world analogy, and the brutal reality of the risks, the benefits, and the massive losses. If you're starting from absolute zero, this is the realistic blueprint you need. Alright, let's start with a simple truth. At its absolute core, cryptocurrency is just a digital form of money. But to understand why it's different from the money in your bank account, we have to look at how traditional money works. Right now, if you want to send $50 to your friend, you rely on a centralized middleman like a bank, PayPal, or Venmo. You log into your app, request the transfer, and the bank checks its private database to make sure you actually have the $50. If you do, they subtract $50 from your account and add $50 to your friend's account. The bank holds all the power, controls the database, and charges fees for the service. Cryptocurrency changes this entire architecture by using a technology called the blockchain. Let me give you a quick analogy. Imagine a small town where instead of using a central bank, every single citizen carries around an identical magical notebook. Every time someone in the town buys a cup of coffee or sends money to a neighbor, they shout the transaction out loud to the entire town square. Everyone hears it, checks their own notebook to make sure the person has enough money, and then simultaneously writes the transaction down in their notebook. Because everyone has an identical copy of the exact same ledger, it is mathematically impossible for anyone to cheat. If one person tries to alter their notebook, to say they have an extra $1 million, the rest of the town looks at their own notebooks, sees that the numbers don't match, and completely rejects the transaction. That is what a blockchain is. It is a massive, public, digital ledger that is distributed across thousands of computers worldwide. Cryptocurrency is simply the digital cash that moves across that public network without ever needing a central bank, a government, or a middleman to approve it. Now, why do people care about this? Why has this technology grown into a trillion-dollar asset class? Because removing the middleman creates 3 massive, real-world benefits. The first major benefit is global financial autonomy. Traditional banking hours are restricted, and international wire transfers can take days to clear while racking up heavy bank fees. With cryptocurrency, you can send millions of dollars worth of value to anyone on the planet in a matter of minutes, 24 hours a day, 365 days a year, for a fraction of the cost of a traditional wire transfer. The second benefit is protection against inflation, which is specifically why assets like Bitcoin are often called digital gold. Traditional currencies, like the US dollar or the euro, are controlled by central governments. If a government goes into massive debt, they can simply print more money out of thin air, which devalues the currency and causes inflation. Bitcoin, on the other hand, is governed by code. The code strictly dictates that there will only ever be 21 million bitcoins in existence. You cannot print more, you cannot manufacture supply, and you cannot cheat the system. For people living in countries with hyperinflation and unstable economies, crypto acts as a financial life raft to protect their hard-earned purchasing power. Finally, there is programmable money. Newer networks, like Ethereum, allow developers to build smart contracts. These are self-executing agreements written directly into the code. Imagine buying a house, where the contract says, the moment the buyer transfers the digital funds, the digital ownership title is automatically transferred to them instantly. No escrow companies, no expensive lawyers, and no manual paperwork. It completely automates trust. But let's be completely honest. If crypto was pure benefit, everyone would be using it by now. The reality is that the crypto space comes with a massive, terrifying list of risks that regular beginners completely ignore until it's too late. The primary risk is extreme volatility. Traditional stocks might fluctuate by 1% or 2% in a single day. In the crypto market, it is completely normal for an asset to drop 20%, 30%, or even 50% in a single afternoon because of a single tweet, a regulatory rumor, or a sudden shift in market sentiment. If you do not have a high emotional discipline, this volatility can cause absolute panic, leading you to sell at a massive loss. The second major risk is the lack of a safety net. When you use a traditional bank, your funds are typically insured by the government up to a certain limit. If someone steals your credit card, you can call the bank and get a refund. In cryptocurrency, you are your own bank. If you download a malicious file, click a phishing link, or accidentally send your crypto to the wrong digital wallet address, your money is gone forever. There is no customer support line to call, no corporate headquarters to complain to, and no government agency that can reverse the transaction. The blockchain is permanent, and absolute freedom comes with absolute personal responsibility. To navigate this space safely, you have to understand exactly how people lose money because it almost never happens the way people think it does. Most people don't lose money because the underlying technology fails. They lose money because of hype cycles and fraud. Because crypto is mostly unregulated, the market is completely flooded with meme coins and speculative tokens that have absolutely no real-world utility. Influencers and creators will launch a token, heavily market it to their audience to artificially pump up the price, and the moment regular investors buy in, the creators sell all of their shares at the peak. The price crashes to zero in minutes, leaving the beginners holding worthless digital assets. This is known as a rug pull. Another massive point of loss is exchange failures. Many beginners don't store their crypto safely in their own private digital wallets. Instead, they leave it sitting on centralized trading platforms. Over the years, multiple massive global exchanges have gone completely bankrupt due to internal mismanagement or fraud. When an exchange collapses, their users' accounts are frozen, and regular people are left waiting years just to recover a tiny fraction of their capital. So, if you're looking at the cryptocurrency landscape from zero, what is the smart, analytical path forward? Let me give you a quick analogy to close things out. Approaching the financial markets is like learning how to swim. Investing in a high-yield savings account or a diversified stock index fund is like swimming in a controlled indoor pool with a lifeguard present. The risk is minimized, the boundaries are clear, and you can build your confidence safely. Jumping straight into active cryptocurrency trading is like jumping directly into the middle of a stormy, unpredictable ocean without a life jacket. Technically, you can survive, but the environment is working against you. If you want to explore crypto, the data suggests a very strict, cautious framework. Step 1. Never invest money that you need to pay rent, buy groceries, or fund your immediate life. Treat crypto as speculative capital. Step 2. Focus on the fundamentals. Ignore the trending coins with animal logos on TikTok. and stick to the established networks like Bitcoin or Ethereum that have proven track records and massive institutional infrastructure. Step 3. Take security seriously. Learn how to use a private hardware wallet so that you truly own your digital assets rather than leaving them vulnerable on an open exchange. Because at the end of the day, mastering your finances isn't about finding a magic shortcut to get rich by next Tuesday. It's about building foundational knowledge, controlling your risk, and making logical decisions that compound over time. If this video helped clear up the digital noise around cryptocurrency, make sure to hit that subscribe button and give this video a thumbs up. And I'm curious, do you currently own any crypto, or are you still sitting on the sidelines watching the market? Let me know in the comments below. Choose wisely, and I'll see you in the next video.